Hey guys, welcome back to the channel, where it's the best place to learn about Canadian finance. Now, it's the end of October and you know what time is it? It's time for Canada's real estate market update. So as always, I prepare a lot of stats and updates to share with you all. Now, before we jump into it, I also want to go over a very interesting article and story that I read this week that a lot of people were talking about, which is about a 25-year-old guy working in Toronto making $70K a year, and he has accumulated 20 properties in the last 2 years. Now, a lot of people were calling this fake or pure insanity. How can someone with 70K own this many properties and be $5 billion in debt? How does that even work? So I want to dive into this article, give some comments, and see what we can learn from this. Now, rental property was going to be a topic I wanted to discuss anyway in this video because a lot of my clients have been going through numbers with me on their rental portfolio. So now I have the perfect excuse to really dive into this topic. Alright, so without further ado, let's jump into today's video. Alright, so before we start, 3 things. Number 1, help me like this video. We spent a long time researching, so hopefully we can push it to more Canadians. Number 2, make sure you join my private group so you get more content, you can ask questions inside. And number 3, like I said before, I've created a list of books and tools that I found interesting that you guys have been asking. So if you're interested, click the link below to access the list. So basically how this guy started was he read a book called Rich Dad Poor Dad. He learned about passive income and he tried investing, but immediately he lost money. So that was his first bad experience when it comes to investing. And this is actually the same experience I had back then. I read the same book. I want to do investing for the first time. I lost money right away. And that's also why I jumped into this field. Was I wanted to learn about how money really works. I don't want to just sit around and invest blindly and end up losing money. So 100% resonated with this part of the story. So with this bad experience, he actually moved on to real estate. At that time, he paid off all his debt. He has 40K saved up, but that's not enough to buy anything in GTA. Now, through his research, he actually found something in 2018, which is a 3-bedroom, 1-bath, single detached house in Windsor for 130K, and he paid 26K down, which is 20%. And this is where he made a second big mistake. Usually when a house is this cheap for a single detached, you're probably going to expect huge overhaul and renovation. And he got introduced to a contractor, turned out to be a bad experience. A 1-month project turned into 3 months, and a 12.5K budget turned into a 25K, so double the cost. So even though this experience was very bad for him, he said that he spent 25K to renovate, but by the time it was done, the property was worth 50K more already. So that was the first taste of real estate investing for him. And instead of selling, he actually refinanced and he repeated this process for his next properties. Now, I don't know if he knows it at that time, but what he did was actually a very common technique called BRRRR, which is buy, rehab, rent, refinance, repeat. And as long as you can service the debt and have good properties to buy, you can repeat this process over and over again. And that's what he did. That's how he ended up with 18 properties in 2 years. And also in the article, he did say that most properties are low cost, 130K to 650K, each giving him around 1.4K to 4K rent across the board. And in total, all these properties accumulate about $5 million of debt. This gives him a net cash flow of 4K a month. Now, if you just read the title, a lot of people is going to call this fake or fishy. How can someone with 70K income borrow so much up to 5 mil and have this many properties? But as you read the article, you realize that he stated very clearly that he is partnering up with other people to do further projects. So he definitely don't own the whole thing, and he likely only own a small portion of the 18 houses. So he wrapped up by saying that when COVID hits, things did get risky. Luckily, all his tenants were able to pay, and he did realize he exposed himself to considerable amount of risk by doing this. So I thought this story was excellent in discussing what we can learn from this scenario and how we can do better when it comes to our own rental portfolios. Number 1 is he goes for undervalued properties, obviously, and he renovate to make the numbers work. And this is a common mistake I see in a lot of people when it comes to rental properties. Their idea of having rental property is they go out there and they buy something like a 500K to 700K condo, and they try to rent it out for 2,000 or 2,500 a month. Now, if you do it like this, likely the number is not gonna work. Just mortgage payment and property tax and insurance is probably going to eat up all your cash flow. And if you add strata, utility, and all the other stuff, you're probably going to be net negative every month. And in my opinion, if a rental property is not giving you net positive cash flow every month, it's not really an asset, it's a liability. And hoping in the future you're gonna make money when price goes up. So for me, that's a very risky investment choice. Probably make much better return by investing elsewhere than doing something like this. Now, the second thing I think we can learn from this is knowing all the risk involved. So from this, he already said he got lucky a couple times because he did expose himself to a lot of risk. And in general, when you leverage to invest in real estate, there are two major risks you need to be careful of. One is the interest risk. The two is the cash flow risk. So the interest part is obvious. For the cash flow one, it's where when you have multiple rental properties and you're refinancing all the time, essentially they're basically chained together. Okay, if one or two properties don't do well, if tenants decide to skip on rent or damage your property, if you're not carefully set up, you could find yourself snowball into a huge issue and could have a domino effect that affects your other properties as well. I've known someone who done something similar. They have 4 houses in Vancouver and they have about $10 million in debt. And because one property ran into issue, they had to borrow to cover that property, which created a debt problem here. And they tried to borrow again from the third house to cover the last problem. So in the end, all 4 properties got chained together. And if they weren't able to service their debt in 3 months, they could end up losing all 4 houses. So if you plan to own multiple rental properties, you really have to be careful. How is it being set up and how is the debt structure working to make sure you don't create a domino effect on yourself. Which brings me to the last point is the legal structure when it comes to rental properties. Now, the common name for this is called 3-tier corporate system. Basically, this is something you really want to do if you plan to own multiple real estates in the future. So how does a 3-tier system work? Basically, you're going to have a holding company, a real estate company, and a management company. So the holding company is going to hold the shares of 2 other companies so that you can flow all the cash flow into this holding company. Now, this company is inactive, it's not going to do any business. It's only there to hold the shares and hold all the cash. Now, the second tier is the real estate company. So here, instead of having all your rental properties in one corporation, an even better setup is having one corporation per rental property. Why do you want to do that? Is because each corporation is a separate entity. If you have one rental property in one corporation, the worst case is you just lose that property, you close down the corporation, you can still keep the other rental properties. So that's the better way of setting it up. Now, the last tier is a management company because the problem with rental property is a passive income. So if you keep it in a corporation, you're going to get taxed at the highest bracket. To avoid this problem, you could create a management company so it will act more as a landlord. It's going to collect rent, it's going to maintain the house for you, it's going to do everything the landlord is going to do through this management company. When you have this set up, you can charge yourself, which is your real estate side, 8 to 12% of management fee. So what that does is that 8 to 12% can be reported as an active business income, and that will help you save some tax. Now, if you're just going to own 1 or 2 rental property, this may not be suitable because the upkeep cost is very high. But if you're looking to own multiple in the future, have a legit rental portfolio, then this is something that you want to do right off the bat. Alright, so that was about rental property. Now, next, let's really look at some updates. Okay, so for the first update, like always, let's check out how the rents are doing across Canada. So according to rentals.ca, basically we're in the 4th month of low average rent across Canada, and you can see that we have stabilized at a lower level. Now, if you look at the map, you're going to realize every single province has dropped in rent except for BC or Quebec, where we've seen 8% and 14% increase respectively. But before you guys write off BC and Quebec as an insane market, all the rent is going up, it's crazy, we really have to dive in to look at what is driving those numbers. It turns out if we isolate the rent by property type, on average, BC and Quebec actually have dropped as well. It's the rental apartment that have seen a significant jump in price. Now, these are specific rental units that developer built just for rental purposes. So either they're selling to investors to rent out, or they hold it themselves to create cash flow for themselves. So likely these are not average condo that you see on the market. Those probably have dropped in rent already. So we have seen that average investors, if you have a condo or a single house, you're likely going to experience a drop in rent no matter where you are in Canada. And that's very important because, like I said before, this dictates how many people are motivated to offload their investment inventories. Now, if we focus on the condo and rental market, here's a chart of an average rental and condo apartment rent changes. Keep in mind that even though Montreal have increased a lot, most of the increase have come from rental apartments. The condo apartments rent have actually dropped as well, as you can see on the next chart. Now for this chart, if you look on the left side, you can realize actually for Vancouver, the average detached home rent is actually lower versus the condo apartment rent. That's actually very, very strange. And that means that for most single detached homeowners, if they're renting out, likely they're really getting not a good profit right now. And one last thing to note is that rentals.ca have stated that for rental apartments, either in BC or Montreal, they're probably seeing a huge increase because there's a lot of back-end incentives given. As we can see a lot online, people are promoting like first 3 months free rent or free rent until end of the year or whatever. Those are back-end incentives and they're not part of the data. And that's why the data may have skew and it seems like rent have increased a lot when it hasn't. Now, next thing that's very interesting is how does the rent do around major universities. So if you remember, I've talked about this a couple videos ago. I said that the moment classes turn into virtual, we're likely going to see huge decrease in rent, especially around universities. So as you can see, rent around different universities have dropped across the board. There might be small areas that have gone up here and there, but on average, it has dropped. And here you can see UT have dropped a lot. Now, speaking of UT, downtown Toronto is facing a huge problem. Remember this old video I posted before where we're talking about invisible condo crash, how there is a huge issue because lots and lots of condos are completing this year or next year, and now a lot of people either can't complete or they have issues renting out? Well, now we're seeing the exact problem here. In 2016 and 2017, Toronto actually have a record-breaking amount of pre-sale units transaction in those years. Now for downtown, because of how tight everything is, usually pre-sale condo is going to take about 4 years to complete. Well, 4 years is done and now they're all completing. But we have no one to rent to because everyone moved away due to work from home. So that's why, as you can see on the chart, you're going to see across Toronto, all these new projects now have a massive drop in terms of rental price because of the COVID and the work from home situation. So because rent dictates how fast inventory is going to stack up for condo and apartment especially, what's really going to happen in the future? Now, this is a very area specific question, but in general, we expect to see more upward pressure in the coming months. The reason why is because in September, we've seen 380,000 new jobs being added. Now, 75% of the people who lost work due to COVID are now back in the workforce. Plus, with school and daycare reopening and also CRB, which is basically CRB but extending for another 26 weeks, we could see a return of higher demand for rental in the foreseeable future. However, like I said, very area specific. I do believe places like downtown Toronto is still going to suffer for a long time, at least until work from home is gone and people are returning back to city center. And as we know, work from home is likely going to last for another 6 to 9 months because of the speed of vaccine research and also the speed of vaccine being administered to everyone in Canada, even if it's out tomorrow. Alright, next let's move on to sales data and see what we can learn from these numbers. Now, thank you for all my subscribers on the resource provided to me. What I'm going to do is try to include as many major places as possible and to avoid the video running for too long. So for this video, I'm just going to point out what I see for major cities. Now, if you're interested in a specific location, be sure to check out my private Facebook group. You have to join it first before you can go in and download all the info you need. But in there, it should include an area that you're interested in. And if not, let me know where I can find data relating to the area you want to look at. So maybe in the next video, I can include that. Alright, first, let's start with my hometown, BC. And here I'm going to be talking about Vancouver and Victoria specifically. So from Vancouver, if we hop onto Zolo, we can see that for the inventory versus sold, it's actually leveled off, but this graph is actually skewed by detached homes. As you can see here, there's a lot less listing and a lot more sold on detached homes. So things are moving fast. whereas condo is the complete opposite. And this is also supported by COT.ca. We can see condo inventory have steadily rising. Now, like I said, currently we're still not into a buyer's market when it comes to condo. However, from what we can see, it is stacking up. And onto my realtycheck.ca, I've included a more detailed chart like last time in my Facebook group. But overall, you can see a similar price drop as last month. However, you need to note that the number of changes have reduced significantly both on the up and the down prices. So this could be because most people have reduced the pricing previously already, and they're not going to reduce any further, and they just rather sit there and wait a little bit for now. So everyone's kind of holding their breath to really see what's going on with the market right now. Now, I do think detached home and townhomes are going to be a lot more attractive and a lot harder in this market. One, due to lower interest rate, and number two, due to the pricing of the condo previously, now is a lot more attractive to maybe pay the same or a little bit more and get a townhome with a lot more space. So for Vancouver market, I definitely think condo is going to be a lot slower moving forward, especially pre-sale projects. I've spoke to a few and they've all told me that they're selling at about 60% capacity. So if you're someone looking to buy a condo and you don't mind waiting a little bit, definitely check out some of these pre-sales. I'm pretty sure you're going to find very attractive incentive and pricing that could make it work. But as always, make sure you research on the builder's reputation and quality before you consider buying a pre-sale. Alright, next is Victoria. This is something I get a lot of requests to talk about. Now, what I think about Victoria from what I see is Victoria is a very unique market. It's next to Vancouver, but it doesn't act like Vancouver. Due to the location, it's a unique ecosystem, and it's very hard for people to come and go when it comes to Victoria. So even if outside the price are dropping, it's unlikely that Victoria is going to experience the same thing. And as we can see from the stats, it's exactly like what I've said. Now, this doesn't mean it has no way it will ever drop. I will talk a little bit more about that in the end of the video. I'm just saying due to the location, it's much harder and much slower, and you really have to see a big drop in Vancouver first before it would translate over to Victoria. Alright, so moving on, we want to talk about Ontario. Alright, so for all the data, I've included that in a Facebook group for each municipality. So if you're interested, go there and check it out. So if we look at Zolo for Toronto, we can see inventory is sky high. Now, almost all of these are condos, and it's reaching back to May's peak at 4.1 month of inventory. This is no surprise because downtown Toronto has been hit the hardest when it comes to rent drop, so that's why inventory is sky high. Now, interestingly, the percentage of cancelled listing is also very high. This could be because agents are not adapted to the new market and they're trying to list at a much lower price to start a bidding war. But maybe very quickly they realize it's not working, so they just cancel the listing altogether and relist it at a higher price. So this is also going to skew with the overall data a little bit, but it's just interesting to see how much people are canceling their listings. Now, for every single place, I've went to house segment, and like before, I've included the absorption rate for different types of property in each area, which shows how many units are sold versus listing. Now, anything below 30%, it's a buyer's market. 30 to 60% is a neutral market, and anything above 60 is a seller's market. So as you can see on the chart, the market has been moving very slow, especially condos in major busy areas. Now, will this stay the same? My thinking is no. So as you can see on the map, this is a recorded movement of where people are moving from and moving to. So people tend to spread outside more and more outward towards Toronto because of work from home. And this might create an upward pressure for housing surrounding the center of Toronto. So people have also asked me about Ottawa, and here's my thinking. Ottawa is very similar to Victoria in that it has a very unique ecosystem due to the fact that it's the capital, and also that's where the major source of government jobs are. Even though there is more unemployment due to COVID, on average, people there still make better money and have better job security. And these people with safer jobs and a higher earning are going to be the buyers of all the properties in Ottawa. This is why, despite we see a huge increase already in Ottawa housing, we're still not in the danger zone according to analysts. The only potential problem I can see is if after COVID, the government want to target the deficit they've created, so they're going to look to cut jobs, and Ottawa might then get affected. but that's very far-fetched, and I see less chance of that really happening. So for Ottawa, I think the market is going to be very, very hot still and very strong, and the price is going to continue to go up. Now, next, I want to move on to Alberta, and I'm going to talk about Calgary and Edmonton here. So Calgary, the price have continued to drop, even though inventory is not adding up as fast as other cities. And as we can see, the market is simply not moving. On average, properties have many, many days on the market before it's sold. Unemployment is very high, and with second wave of COVID coming, it's probably going to further damage the economy of Calgary. Now, this city is extremely dependent on the energy sector, so as long as energy price don't go back up, I don't foresee any upward movement anytime soon for the city. I've included more information in the FB group, so if you are interested, you can take a look there. Alright, finally, it's Edmonton. So as we can see, inventory are starting to build up. Prices have dropped overall. However, it's not as bad as Calgary. This is due to more government jobs and headquarters being located in Calgary. So like Ottawa, job security is higher. And this is true because as we can see before, even when Calgary's unemployment have gone up, Edmonton's actually have went down. One interesting thing to note is when I was reading the report, they said that for Q3, they have stated a decrease of 21.5% in builder activities year to year. So people are probably seeing a much slower economy, and builders are reluctant to start new projects. Now, usually this is a normal cycle when it comes to housing. Usually we're lagging behind, and because housing takes years to finish building, so what's going to end up happening is when they stop now, it's going to create a potential housing shortage further down the road in the future when economy recover and people are looking to buy. Because we haven't started this years ago, now there's not enough housing to be sold to the new buyers. So when the economy is going back up for Edmonton, we might see a very quick reversal from a buyer's market into a seller's market right away, just because builders have stopped building in Edmonton right now. Alright, so let's talk about what to look ahead moving forward in the future. So we've basically entered the seller's holdout phase that I've stated before into major cities across Canada. Now we need to pay attention to potential upward or downward pressure exerted across these cities. And I'm not going to repeat the common things we talked about already, like for example, vaccine being developed, low immigration numbers, students not returning, etc. Instead, I want to focus on something specific, and that's debt. So there are two things here. Number one, mortgage deferral is officially over this month. So here now we're going to really observe how many people are going to have difficulty servicing their new mortgage payments. And if you have seen in my previous videos, some people is going to see a very little increase in their new mortgage payment. Some people is going to see a massive increase. So this could create a potential problem where number of people cannot service their debt, and we might see more foreclosure, which is more inventory in the future. Now, second thing I want to talk about is the amount of business loan that's tied to real estates. So as you can see on the graph, we have lots of business loans that are tied to residential real estates. And on the other hand, we've already seen many reports coming out saying an overwhelming of small businesses do not see themselves surviving in the long run if COVID doesn't go away and economy doesn't recover soon. And not just small businesses, we can also see that big brands are closing down across Canada. So if all these businesses are going to run into issue in the future, and we have this many business loans tied to residential units, we could see a lot of debt being written off and a lot more foreclosure happening than we initially expected. So if that really happens moving forward, this will create a massive downward pressure onto the housing market because of the number of inventory that's going to be stacking up. Now, this is something that I'll continue to monitor, and I'm continuing to research on different things that can impact our housing market. So if you like these videos, I do upload one every Tuesday, 8:30 EST. So make sure you comment, like, and subscribe to my channel. Click that bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next Tuesday. Bye!